Bye-bye. So can I be asking people questions? Since people know how to ask me questions. Okay. Yeah. Yeah. Elliot wave theory. Okay. Okay. So I believe everybody has been in class. So somebody in the comment section or in the chat room should come and answer that question. Come and explain what has been taught to you. So the question is, what is Elliott wave about and what is Fibonacci about? So I need somebody to volunteer. Who wants to? I will call somebody because they were in the class. I want to volunteer. Hmm? Okay, you want to try Fibonacci? Okay, oh yeah, come. Sha? That's the easy one. The easy one is
Next you.
oh yeah. Explain Fibonacci and make
Fibonacci replacement tool. The tool for that helps us in making our analysis. So the rule about Fibonacci that most times happen is that in Fibonacci we have different levels. I think we have level 0, we have 31, we have 50, we have 61 and so. So for each Fibonacci retracement, when you place your Fibonacci, the price, it makes sure that it goes to a rejection point, it either rejecting one of the level. Like let me use one for instance. Let's say for this one now, we will take our Fibonacci. Then you place it as where the price started from. That is the lowest point of the area. That is for a buy market. Lowest point. Yeah, this point. Then you put that the highest point of the where the price will get to before it started with its retracement. So this is the point. Let us say for this one, when the price was coming, it started from here. Then when it got to this table, so when he got to this point, he made a retracement down, giving us an indecision candle here. So that means that the price wants to continue his bullish movement. I don't even understand what I'm saying. The concept behind Fibonacci is that after the market movement, it always come down to retrace to a level. And at this point, we have different levels here. We have level 0, we have level 0.38, we have level 5, we have level 0.6. So the market makes sure that it come and trace back to one of these level. It might retrace here, it might retrace, but the main area that the market retrace to is 0.5. That is like the main area it most times retrace to.
Let me explain my own. Let me explain my own words. You tried. Come for him now, please. Come for him. Come for him. Come for him. He's correct, but he's speaking English. Let me make it for you so you understand. You know how trend they go now. It's like this now is going up. When it starts, it always has small box stop to just stop, pick up passenger, then fire again. So that's what they use Fibonacci to know where exactly those bus stops are. So like now, this starting from here, it's going to the uptrend. As no, you know, go straight once, you will go, come down small, fire they go again, until it gets to the peak of the whole trend and start coming back down. So those stops where it stops are places that are potential entry. So in case you missed it here, if you say I'm going to see uptrend, here now the retracement, where we enter before they go again. So not like say they go from Lagos to your village, go to for Oge, come buy bread, banana, and that kind of thing before you fire they go. That's exactly what it is. So now, this point now, there's 38, there's 50, there's 61, all these are percentages. You understand? Then this one, our Oga for here, he has one coded, this that you can use to say, let's one Egunje. That's 0.27 minus 0.27. So, for instance, now, if when it goes, and you see that at some point, starting to retrace, just draw your Fibonacci. It's a 2 somewhere here. Let me come on this one. So it's a 2. This is it. So once you hover over the 2, you see Fibonacci retracement. Sometimes you see it, but this is just because he saved as a favorite. That's why you see it here. But if you not save as a favorite, you not see it here. What you see, you have to come here and click on it. So this is it now. Look at it. If I click on the small arrow now, see, okay, so, sorry, this is not it. Now this one. So when you click on it now, you see Fibonacci retracement. So because it started it now appear here, all these bars. Okay, so although you need to go and watch your videos. So when you click on it and choose it, the lowest point of where that trend is, you start from there. I'm assuming this is it. No, this might not be it, but this I'm just assuming this is it. So from here, you just hold it and drag it to the peak of that place where it was trying to bend. Once you leave them, you just click on it again once. You don't balance inside. So now, it might be here, but you have to wait for it to either touch 38, 50, or 61. But most times, usually the 50 and 61. That's why you put it red. Sometimes it bounces at 38, like in this case now, it bounces at 38. So once it bounces and you just see some candlestick patterns here, just know that it's time to enter bus and continue your village journey. You understand? So this is where you now enter. And this 0.27 is a potential TP1 to collect your first. You understand? Then, but the trend is still going, though. You see at the top. You see that it's still going. But this one is a quick, a good jet. You understand? You understand me now? You understand everything we just said now? You understand? So that's basically it. So every point, like now, this one now has finished its own retrace. This has finished your retracement. So you delete it, and then you now mark the second one. That's from here. I see it. So now, like this one now, this one has even retraced down to us 0.768. Let's see. So they always touch this 76, 61, all these levels. They always touch them. Although at this point now, we can see that this one now, now only ranging market. So no need to, but you get the idea. At this point now, you don't reach that area to where you talk now. You don't finish the ABC, you don't finish the 1, 2, 3, and it's now at the ABC level. That's where there's a lot of the trends. Any questions on Fibonacci? Okay, oh yeah now. Oh yeah, come and carry my phone. Come on, come on. The record, come go and carry my phone first. You don't want to come outside.
Not in the ringing market. So in addition to it, I said Fibonacci is mainly for our entry, just to get your entry. Entry, yes. just to get your entry. Like what they said, like in this kind of situation here, you can see this impulsive move started from this side, then you got it to this level. Then if you miss it at this level, you won't just enter like aggressively. You wait, you place your Fibonacci retracement. So you started it from one here, you place it here. You can see the first number, you make sure the one is on this your pullback here. Then the zero will now be the target of that impossible where it starts retracing. No, you place one here, you can see this level here now. This is one, right? This is one. Then zero will now be the highest point before it starts retracing. So you get. So you place the zero here. So this particular one is supposed to be here because it started retracing from here down to this level. Then we've already have the Givens level that the Fibonacci retracement will retrace to for you to get another entry. So as it was coming from here like this, you retrace from 38.2 to 0.50, 50% of your VBA. Then you can get your then addition with your candlestick confirmation. So you now look for your go to your down lower time frame. Then look for your candlestick pattern that will confirm your entry. That this thing, you know how to read the candlestick pattern, right? So once you get like maybe something like bullish engulfing or your morning star from that place, now you can now know, okay, definitely it's going to go up. Then you can enter for it. Then your like your the way they said here, this 27 0.27 here, you can use it as your potential, like for your take profits. So you get just like that. So that's just all about it. And you cannot use it on the ranging market. It only work on the trending market. It's either down trade or the uptrend. So that's just it. That's what I have to say about
So do you understand? Okay. Oh yeah. The stage is yours.
Good morning, billionaires. For Fibonacci, I want to add a little. No, some now this market we have already seen that no best. This market don't say and sit on the range. You understand? You don't already the come down already. You don't already sit on come down. But in case you go only for charts, the market they go up. Like as I was saying, that the market moves in an impulsive move. So Fibonacci, my own understanding is to catch the next impulsive move of the market. Either it's going to up or down, either of the trend pattern. So Fibonacci, for an example, now this market, I don't need to say you don't need to retrace. But in case say I did for chart, I never said a market does go up. Now, how I want to know the market want to retrace? I will see for an impulsive movement to the upside. That's a bullish trend. You go to go up like this now. As market won't come down, I go to see a red candle. Don't they come down? Don't they come? So as I said, I go just carry my Fibonacci immediately before they come, just to target how it go come down reach for the next impulsive buy to the upside. So that Fibonacci you can't help me, can't get like blessing like expo. So okay, let me put on here. Say if you reach any of these ratios, then I can't see candlestick pattern. Say market one waka they go front. Oh, I go immediately place buy to catch the second impulsive buy to the upside. Thank you so much.
Thank you. Yeah, Let them finish Fibonacci.
All right, so
All of them will come for Fibonacci. Come for a lot of no, people will never go talk today now. Celeb, celeb will never talk today.
all right, so this Fibonacci also too, each of these lines that we see act as support and resistance, and depending on the kind of market that we have, if it is an uptrend, this support, if market don't pass them right now, meaning that this place will be acting as a what support. If it is an uptrend market like this, it is going like this. So for the market to have gone here, like if the market has passed it, now we now know that this place is not acting like a support, right? And this place like a resistance. So there's a potential interest for the people to retrace back from here to this place. Are you getting it? Then also too, once it gets to any of these points, it can also return and go up. So that's what I just want to say. That each of these lines can act like support.
Like most of the time.
Okay. Okay, so that's 50% and 61%. And that's why I feel like it is highlighted here. They call it the golden zone. Golden something. They call golden zone, Abby. They call it the golden zone. This too. Yeah. So then I feel this one is even supposed to be here. I feel this one is supposed to be here. Abby. Because this is a retracement here. This is a retracement here. Ah.
Actually, yes, you have first. Yes, of course, we already know. Yes. So just watch the videos, old videos. So, watch old videos. Like the first one. You see,
Yeah. So do you understand Fibonacci? So basically, Fibonacci is for getting retracement of an impulse or market trading like this. And most times, especially when you trade, okay, you want to have a you want a question. Okay. Yeah. Okay. So now, okay, like where I have a bullish confirm, how do you know that it's going to go back up? I don't understand. Okay, your TP. I know. See, that's why they have levels. You understand? See, most times to get back to the zero or 0.27, most times, and most times, especially gold, most of like I would say like 70% of the time, if gold makes an impulsive move like a very long, it always retraces at least 50%. Most times, if you check characteristics of most of these currency pairs, especially gold, it always retraces back to 50% at least most of the time. It's not all the time, oh, but most of the time. But you understand Fibonacci, right? Oh yeah, okay, a lot with. Oh yeah, as una dey raise hand for Fibonacci, make I raise hand. What? Class captain. Oh yeah, who wants to explain a lot with to us? Hmm? So I'm going to make just an introductory, since I'm it's not your teacher that's supposed to be teaching you, it's student that's supposed to join you. I mean no be here. Michael, this is no work. Okay. So basically, Elliot's wave is was created because somebody made a research on the market and discovered that market does not move in a hazard manner. It moves in a wave. You understand? So basically, for Elliot's wave, we have something like this. We have the one, two, then we have the corrective wave. So this is called 1, 2, 3, 4, 5. Then we have the 1, 2, 3. No, sorry. This one, sorry. So we have the, so this one, two, three, four, five, and so so basically, Elliot's wave is like, for example, now most times in a impulse mark in a trending market, in the middle of a trend, number first thing that Elliot's wave makes you understand. Now I'm just want to, I want to lay a foundation. I want to lay a foundation that you will not call. Oh yeah, oh yeah, there's oh yeah, oh yeah. Come on. Come and explain what you know about Elliot. You really want to open the class. No, I will do. I will let
Elias wey hard. You say
oh yeah.
But it's not nice now.
Can you suggest that?
that's Leicester. Get the mic where you won't hear your voice.
My even doing my.
I'll catch you for office. Good morning, billionaires. Una no laugh, my own understand of Elliot theory. Our teacher tell us, say, you understand? The market moves in waves. There's one guy they called Rav Nelson Elliott. Say the guy took some time, some years to study, about 70 years of his life to study how the market moves. So he discovered that the market moves in patterns. That the market don't just happen, that it is predictable. So he came up with these waves. One I understand very well is that if it goes in one, is he here? So the market moves like if it moves up, it will retrace. So this one that goes up is 1, 2, 3. 3 is already the longest. 4, then 5. Then the retracement of the market will give you A, B, C. Are we together? Now, people, do I use Elliott theory in my practice? Now, since this market moves in, this is 0, 1, 2, 3, 4. Abi, this. Sorry, I learned. So this is 3 right here. 3, 4, yes. Then 5. Right where now? 5. So this is A. Write this in there. You understand them? B, C. Do you understand? So since it says that 3 is always the longest. Now, if I see a market moving like this, I want to use it. It goes, this is 1, right? Then retracing. Now, if I want to catch the next move of the market, I will place my Fibonacci here. That's how I use it. I'll place it here. That market, I will find the market is the longest. I'll just predict. There's one Fib trend my friend showed me. I don't know what it's expression of trend something. So in place, it tells you where the next important movement will end. So as at that, if I notice that there's a candlestick pattern that informs the market is going to the upside, I will place what I place is that I can able to put a buy and put a TP, not at the end, but very close to the end to capture that particular impulse to the upside. Do you understand? The same thing with the retracement back to the downside. That's this one about Elliott theory. So also this market, this impulsive movement now on the higher time frame can see one candle, but on the other you saw that fractals going like this. That this one will give us 1, 2, 3, 4, 5. This one will give us 1, 2, 3, A, B, C. You understand? That's how it works. So if I come, sometimes we see a chart, guys, that have different. This you can trace it as 1 because on the higher time frame, stand as a single candle. Am I making sense? Thank you, sir. I think I tried. Clap for me.
Thank you. Oh yeah. Oh yeah.
I want to add to what she have said.
I impressed. I'm impressed. I'm impressed.
I want to add to what she have said. In the Elliott wave theory, when the market starts is impulsive movement. When the market start from down and going to this is the one now. So for the second movement, it's not supposed to come below the first movement, and that is it implies the same thing to the four. This when the market this is your one, this is your zero, this is your one, this is your two, the okay yes ABC. Oh. So for your impulsive when your market starts is impulsive movement, the retracement it does, it should not get back to the level the starting point it was before. So if it gets back to this starting point, it can act as a breaker block. That's for people that trade ICT. it can it, no, it can stand as an so it's still the same thing as she said. So when you are seeing the after you have gotten to the fifth movement of the Elliott's wave theory, you can just place your Fibonacci to know the retracement. Most times the retracement gives you the ABC. So let's assume now you place your Fibonacci from somewhere here,
It's called a corrective.
a corrective wave. So the market most times, let's say this is the point that this is your 5%. Most times the market gives you like an A, B, C to the 5%, then continues its movement to an uptrend. That's basically the level of Fibonacci.
So me, I want to ask a question now. So that for the benefit, why is wave three usually the longest?
So actually, it's not supposed to be it's not is long is the longest, but the thing is that the scenario beside it is that it can never be the shortest. That's the scenario between wave three. That is the way you can get your wave three. It's not meant to be the shortest. If it's the shortest, that means I'm not sure that is the Elliott wave theory. Yes, for number three. Yeah,
Alright, thank you.
Okay, so this Elliott wave is kind of confusing. That's the truth. Very nice, very confusing. So I now did my own small research. Thanks to our able ChatGPT, he now explained to me the Kurukere way you can get number three. Because sometimes when you see the trend going, you think that no one is number three, but it's not number three, it's actually number two. And sometimes it's vice versa. So when I asked ChatGPT, I made some inquiries. He told me that there's a Kurukere to it. That what you can do, which is what she was trying to explain, is that when it starts here, yeah, and it gets to number one, and finishes that number two retracement, there's something called Fibonacci trend extension. Extension. So it's like a cousin of Fibonacci retracement. So what it does is when you hold it here, you drag it to this place. It needs a second one, a second point. No, normally you judge Fibonacci from one to the second place. But in that one, you have to drag it from here, hold it here, and hold it here. It now give you another kind of Fibonacci up here, extended price and everything. So what I now learned was that, and I also checked it, backdated and checked that it was actually correct. Most times it falls under, it has its own numbers. It's not 3850 and all that stuff. It has its own numbers. 161, 260 something. So it's always around that 160 something. I think it's 161.8 and 200 and something. But usually this 161.8 is usually around that side. It might not touch it to, might pass it to, might be it on dots like that. That's how I now get to know that that's number three. Sometimes you see this like this, something like this, 1, 2, 3, and then you go again. You don't know which one is number three, or you don't know which one is number two. By the time you do that one, if you drag it here, and it starts from here, it will tell you that this one is number one, is original number three, not this one. So it's that thing that will help you know which one it is. So that's how I don't help to now my adult wave understanding. You understand? So and I noticed also
Let's contextualize it.
okay. I also noticed that at every once a trend finishes, that ABC is usually a consolidation. That's why it's called a corrective move. It doesn't continue the trend. So once you see that number five, that any point where you see where you know they shake, that part is number ABC. So that's my own. So let me show you how it looks like. Let me use a mouse. Okay. So for instance, this is a this one not still go, so we don't know which one where it's ending. Let's go back and see this one, where is forwards. Let's go for a good trend. So I was gonna say all of them are interesting. Okay, let's see this. So I've been using uptrend since. So let's try and do downtrend. So now there's a lot of arguments. Sometimes they say it's subjective, but yes, but it's not really subjective. You have to when you use this pattern, you discover that there's actually always a range, an area. So now this is where you start from. This is your number one. This is your number two. You know, we are going back down now. We're not going up. So you might say this is number two, but we don't know it. We're not really sure. This could be number two. We don't know. So let me assume that this is number two. So I'll take that to Fibonacci trend based Fibonacci. That's it here. So when you click on it, you click once to your potential one and your potential two. Let me drag it so you see it. Now 161 or 200 is usually the number. So in this case now, if I'm using this as number two, this guy here is your number three. Have you seen it? It's already around this 161 or 261, it depends. So if I still drag it away now, I'm bringing it on number two. Let me do this one. If I say that this number two now, start from here and do this. That means this has just shown me that this is number three. Like this original number three here. Have you seen it? 1.6. This is the original number three here. Not that first one I first did. You get it? When I first did this one, in my mind, I thought that this is number two. Abi? Look at it now. I see it. It should be around this number most times. But this one, you can still fall under this one, but this is the original number, 161.8. Now, at this point now, you can even this one self, you can move the number three self, but it doesn't touch it on point. You get. So but if I use this one, if I use it again now and say you're my number one, this is my number 1, and this is number two. See how this one touch it on point. So this is my number three. So now at this point now, let me hide this one. This is my 0 now. What happened now? Okay. I should use the line chart. Okay. Let me hide this one. Let me hide this one. Okay, so wait there. Yeah. Okay, then that. Let me show it so I will see. Okay. I know the see how. Okay, see how. So I have to draw it on top of it too. So I'm gonna go fix here. So my brush. Huh? Okay, 1, 2, 3, okay. Okay. I hate wire. I hate this wire. That's here. From here to here. Why is it showing two? I see it. This is my number three. Original number three. I see it. Four. This one. Four. Well, which one original number four? I see it's on high pass up now. This one now. That one is the same thing now. This one is the same thing. It's now that's it three matter. This one is big sir. So this is number four. This is number five. So this is now A B
Let me now show you. You see this wave, you count us now. See this wave where you count now.
uh,
The daily time frame is correct.
this one. Because of course on the yeah on the
Go to daily.
daily. Yeah.
Yeah.
So but you see that this number five has ended this trend. The new one that they rise. So that means that this is actually number five. That's actually number three. Impossible now when the ones where they go the journey. The one where they follow the journey.
Let me show you. See this? This is called an impulsive. What type of it is?
This power.
Go to like 30 minutes. It's something like this. Right? So this impulsive move can either be caused by maybe market opening or fundamentals. Understand? Because most of the time you have a basic idea of the fact that market moves.
I've seen the teachers.
So when the market moves outside its normal structure like this, like you see this long candle right here. It's you see how all these ones were moving little little, but there's an impulsive move that happened here. What time? Let me see. Give me what time is this? Give me this cursor. This 2 o'clock. So this might probably be a fundamental news that caused this bullish candle. So this is called impulsive. This wave is called corrective. You understand? Because most times, like you said, if you are using Fibonacci for this, you see that this thing even completed more than 50%. You understand? You understand? So most times in impulsive move, after an impulsive move, there has to be a corrective. Markets won't just keep going like that. Do you understand? So an impulsive move is a move that happens out of structure, like probably due to a fundamental or because of a market opening. Because market openings too cause impulsive move. Because for example now, like let's say basically every Nigerian they wake up 6 o'clock. So imagine that every Nigerian is a trader. So as soon as every Nigerian wakes up 6 o'clock, everybody open MT5 and starts trading. There is going to be a massive movement in the market because a particular set of people have entered the market at the same. That's yeah,
Why is that Asian market is so strong? They don't like trading.
dropping as in
It's so
choppy.
no,
Is So most so Asian section, you can't compare Asian section to London or New York section. You understand? So when Asian section starts, it's always, but it will now be there because of the fact that there's no much liquidity in Asian because it's just Asian section. It's not most people don't trade Asian section, so there's no much trader in trading. So that's why it's always, you understand. So that's that about that. Do you understand? Yeah. So when market makes an impulsive move, it will make a corrective move. Yeah. Yes. Yeah. Yeah. So what? Let me say one thing about Elliot Wave. One is very minimal, but it's something that is a little bit important to note too. So most times, most times the concept of this being the longest is that sometimes when market starts to move, right? I want to make it in a practical term now. You don't usually know the movement of the market most of the times, but when market is in a trend, like let's say an uptrend or a downtrend, when market is trending like that, the first most times you don't usually, let's say the market just entered the trend and the market was buying before, it was consolidating and now breaks out into another trend. Most of the times you don't usually catch it at first. You understand? So the first wave happens. When this happens, the people that caught it here, the reason for this corrective wave is that people took out TP. You understand? So there will be a little bit of corrective. So now when this happens, that is why people will now notice that okay, something is happening here. That's why this is usually the longest because a lot of people now jumping into this. So you understand? So a lot of people jumped into this, understand? But this corrective movement happened because this one is now already getting too high for people to, you understand. So there will be a little bit of corrective movement before you understand. That's why most of the times number three is usually the longest. You understand? So you watch video. Okay. Okay, like I said. So like I said, when markets like market was buying before, most of the times for you to determine that this market has started trending in this particular direction, you have to see a structure. So people that were buying these markets were buying and took out TP and the market retraced here. So when this happens, you should know that there would have been some previous structures that happened here. You understand? There has been a lot wave corrective so this market broke above this structure and started trending. So when this corrective movement happens, now for me to now know that this will now continue, probably you now see a candlestick pattern that now determines that there's a rejection to the upside. Most people will now jump on it at this stage, most traders, because they now see a structure. So most times that's why this will now become a wave that is long because there's now the number of people trading that market now is now more because they now see a structure. So people will now jump in to now cause this long streak. But then market always moves in wave. You understand? When markets you don't inflate price too much. This is just this thing you have to understand that this thing is economy. This thing is what deals about economies of countries. So a price of thing cannot just keep going high and keep going high. At some point it has to retrace, it has to correct. So that is why this corrective movement we make and that's why most of the time corrective movement does not go back to the, you understand, does not go back to the starting point. You understand? For example now, there was a time that Obalende to Faloma was 100 naira. That was a wave. You understand? It grew to 200 naira, right? Another wave, it grew to 300 naira. You understand? So at some point there has to be a corrective measure. You understand? Probably they reduce the price of fuel. They'll now bring it down to 200 naira. You understand? And that's how it moves. So people bought here. So a lot of people entered at this market, causing this wave to, you understand. So they will now market will is already overbought here because the relative strength index will show that probably the market has overbought. It has to retrace. So people took out their TPs, saw that okay, you can't just let us be said. So that's why this market will correct. Then to now continue, then you now see this corrective measure. Most time, I think some of the time, that's like Elliott wave can be a little bit. Some of the times, this does not mean that this thing has changed trend. Some of the times, but from what I mean, I don't know about Elliott wave, but so it is not a confirmation that a trend has changed. So you can't just say that because you have seen a corrective bid, the market is no more buying, it's not bullish, and entering sales. You understand? You have to see, you have to join it to other confluences. You understand? That's where your market structure, your price actions, you understand. So that's just, you understand what I said. All right. Oh, yeah.
What conflicts you?
Confluence. Okay. Confluence means that your ways of when your sentiment, yeah. So confluences mean that the things that you have to check for you to the things that you have to look out for you to know that this market is doing this or this. So basically, for example now, like there are different ways for you to, because there are different types of traders, there are different ways people check their confluences. But me, I'll give you some of the confluences that me I use to trade. I've said it before. Me, before I enter trade, one of the confluences I do is I check my FX street first. FX street, I'll know what is going on in the economy. Yeah, that's where you see news, foreign markets news. FX is called, yeah, it's a website. It's a FX street. No, no, not really. Let me. You can download it too. FX street, because you need to know what is happening. Yeah, because you are trading economies, you have to know what's happening in the economy, because fundamental news is caused by changes in economical factors and others. So you need to know what is happening. Like for example now, you need to know the result of the fight that's Israel and Iran. You have to know the outcome. Yes, now you have to. Hmm? So you have to understand that, okay, if for people that are trading stocks, like stocks, you are trading US oil, you are trading metals, you have to understand that wars cause changes in markets. So the way Iran hits Israel now, it will cause some significant change in some markets. Yes, you understand. So one of the confirmations I make, one of the confluences I make is that I check, for example now, if I'm somebody that I trade Euro USD, I come to my news and check. This is news. You can compartmentalize your news to whatever you are trading. If you are trading just Euro and XAU, you just go and choose Euro and XAU. Yes, XAU is good. So you can check your charts. So okay. See, this is what is happening. This looks like COT data and all that. But if let's go, I come to news, forex news. So this is where you can tick out whatever you trade in this place. Like commodity, if you trade commodities, take gold, you can tick whatever that you want, you understand that you want to or have access to. Ah. So you have to read it. So for example, now if I want to read a news on Euro USD now, this is 54 minutes ago. I check, say what's happening with Euro USD. So they are saying EURG edged lower within range and amid higher geopolitical tensions. That means that Euro USD is currently sell. It's one of my confluence. It is not a confirmation. So within there's a particular they have a technical outlook. So yeah, yes, you see it. Yes, you get it, you get it. So there's a technical analysis that guides you too. So now that I know that okay, oh, in the last 1 hour there has been a selling pressure for Euro USD. So next thing, that's my confluence one, right? And I come here, I check on this is my own way of entering. So people have different styles. So I come here now, I check my strength, my currency strength. Understand? Euro is a bit strong. GBP is very, very weak. USD is weak. So all these bars they indicate the strength of a market at a particular time. And you have to note that these things it can change in the next 30 seconds. In 1 minute, this thing can enter green, full green. You understand? But then it's not all the time. So that's when your session now comes in. So you are not going to be checking it during market. You have to check it in inside the section. You understand? So this is my confluence too. Then I now go to my chart. That's when I'll now do my technical analysis, right? I trade USD, so you know that you are going to be looking at DX. So I check my DXY. What is DXY? Because I trade a pair that is paired with USD, right? I check what's DXY, what is it doing? DXY is currently selling. And using my idea of correlative market, you know that if DXY is selling, if you pair anything that is DXY, it might probably be buying. Do you understand? So probably if I want to check XAU now, XAU is buying. So my first confluence is that I check for my news, right? I check for what is happening in the market. I check my strength. I go to my this can apply as fundamentals because you have to combine your fundamentals and your technical. So this will apply for my technical and for my fundamental analysis. Then I now go here, I do my technical analysis. Then and I check where is my currency pair, where is my pair, what zone it is it at the support, is it at the middle, is it ranging, is it, you understand? You put your Fibonacci, you do your everything that you want to do before you now enter. Okay, yeah, you now check. Okay, for example, me now, I check confluence one, confluence two, confluence three. Then I now go to my chart gangan. So for my chart gangan, I have confluences in my chart, which are what? These zones, right? You have these zones, right? You have zones in a market structure. You already put in a channel to determine that okay, what is the overall sentiment of this market? The overall sentiment is a what? We are in a bullish market trend. So in a bullish market trend, you know that any any trade that you are looking for has to be according to the trend as long as the trend has not broken structure. For example, now we have a higher low, higher low, higher low, higher low. Now look at this place now. See where this market is now. The market got to this last low. There was a break of structure here, but this has not really confirmed that the trend has changed. Why? Because there's a rejection that happened here. So it is still going back to the upside. So this market will probably get back to 3430 in the course of the week or in the course of the day or whatever. Do you understand? So that's what makes me now okay. Oh, probably I can now put my Fibonacci and I check okay where is it going to get to, but I know that this market will definitely get to this zone. So I check my structure. See, this looks like, what does this look like? It almost looks like a head and shoulder, but it's not. But there's no structure. There's lower low, lower and high. There's a structure. You see, yeah? Yeah, it's not yet com- complete like that. So it's so, so my sentiment, if I want to tell you my sentiment in this market, my sentiment in this market is still a buying market. Because at this point now, market got to this, almost got to the support channel and it rejected. So we are having a series of higher highs. So this has to create a higher high. So I believe that this market will still buy, at least come here to this zone, then trend before we finally get to here. Do you understand? And that's what I do. That's how you get your conferences. That's how you do your. So there are different conferences that people use. It might be different. My own conferences might be different from whatever you use and all that. So you just have to know what works for you. You understand? Yeah, come and explain what you want. So after you've checked all your conferences and you see that it checks out, you are confirmed that okay, so make all the conferences that you check, like you have 80% confirmation that you can enter a buy market or you can enter a selling market. Confirmation is when you have checked your conferences and you have seen that it aligns with whatever the technical is doing. So you can now enter your market because you have had confirmation of.
All right. Pardon. Sorry. Initially, I just want to add to what you explained to me about the impulsive and the retracing and the corrective. So, like for instance, now, okay. So I say I just want to add to what he explained to him about the impulsive and corrective. So, in my own understanding, in any market, once you understand the market structure, so you know, in an uptrend market, we have higher highs, higher lows, higher highs, higher lows. Then, when an impulsive move happen, there must be a correction, and that correction, the next impulsive that is going to happen, it must break structure to the upside. It must break structure, breaks above the previous high of the candle. So my own impulsive move is it must not necessarily be like a single candle like this. Again, like let's say for instance now. Okay, yeah. In here, let's say from this particular place, okay, let's say from this particular place to this particular place is an impulsive move from here to here. It's an impulsive move for this market structure, this uptrend structure. Then from here to here is a correction or corrective move or retracement. So you get or pullback, whatever you can call it anyway. So this is the next impulsive move. So the next impulsive, you can see that this impulsive move breaks structure to the upside, breaks this to the upside. So that's my own. Then when you see the market, this next corrective move is supposed to come down to this line, maybe 50% of this impulsive move, then continue to break another structure to the upside. then you violate this guys here. So you now break it downward. So in other words, you can say, if not for the cause of this our Elliott wave theory. So here now you can say if this particular one, sorry, break this structure to this downside, is what we call a change of character. Instead of this break of structure, BOS should be seeing BOS in an uptrend going upward like that. Then when you see a market violate this guy, this lower low, higher low here, then it will now break structure to the downside. Means it's change of character. The market wants to change from an uptrend to the downtrend. So that one. Then secondly, what he was saying about the market fundamental and the technical. So I just want us to understand that me personally, I cannot advise anybody to, whenever you want to trade markets, you should look out for your fundamental and your technical. Because fundamental, fundamental and technical. So technical analysis is basically the chart you get. So why is because technical analysis show you how price move. Why fundamental explain why price move the way it move. So you understand. So when we are having a series of higher highs, higher low, higher highs, higher low, all of a sudden you just see an impulsive movement to the downside. You now be looking at what happened. So you might set your maybe buy limit or enter the market from this guys here. So you now just see like big what do we call it? Bullish, bearish engulfing candle to the downside. You now be looking at what happened. If you check your fundamental at that particular time, there must be a news that goes against the particular pairs that you are trading. So if you have checked it before you enter the market, you will be informed before that particular time that okay, this is so too. If you're already in the trade, maybe you should take partial or you get out completely. If you know that this particular thing is going to go, most of the time they use that news. They used to use it to manipulate because most of the time it will go to come and stop people out. Then after that, it will not be going to their direction. So in that case, if you are not in the market already, so you can just wait for that news to play out first. Once it played out, and now see your candlestick confirmation that okay, this market wants to be going your direction, then you can now enter for a potential buy or whatever the market structure, the market you are trading. So that's just okay. Yes, yes, because if the your market structure lets you know that in an uptrend, there is higher highs, higher low, higher highs, higher low. So for another higher high to form, once you've already the market have already retraced, it has to break structure to the upside. So breaking structure to the upside means exactly just here like a hair. So you can see this particular one. There's a higher high, higher low here. This move, it has to break above these guys for you to know that okay, this uptrend is continuing. Then this one now, when it got to this higher high, then another corrective move. Then after this one now, it has to break above this one again. So before it continues. So whenever you see maybe from here now, it retraced here, then it now got it to this point again. Before it failed to break it upside, it now retraced back. You can see at that place, we see a double top. So that double top simplifies that. It's just showing you that maybe there must be a change of, there want to be as in like a change of character. Maybe market wants to change to be dance, or you want to go in a ranging.
For example,
like
when
what
you
is
see
ranging?
this now,
So you get. Yeah.
you know that there's something happening.
Exactly,
Market
yeah.
because the next impulsive movement was supposed to break above.
Break above these guys, so you get.
So you should know that there's something happening here. So there's a change
Change
of
of
structure
character,
here.
yeah.
That's why you see a series of lower lows.
Exactly.
Now,
Lower
it broke the structure again and created higher high. Understand? So
Yeah, that's the greatest. That's the perfect example. So that's it. Okay. Okay. Sorry.
Is it the same thing? Pullback, retracement, and corrective.
Exactly.
Are they the same?
They are the same. Those
Just
three
like saying
words:
short,
pullback,
bearish,
corrective,
sell.
and
So
retracement. They are the
markets
same.
forex
Yes, yes, yes. It's the same thing.
So some people
is English. So you can use any one of the theory for retracing correct. Exactly, it's the same thing as the divergence as well. So that's it.
So it's the same
Thank you.
thing. Retracement to corrective movement to
Sorry. I can
no divergence is
so
different.
okay, yeah, it's different, but it's like change of it's showing that maybe market wants to change.
Thank you very much. Thank you very much. You guys are good to go. They are good to go. So I think that's all. Class captain. What's the next? Where's the next thing? That's all for today. That's all. So all for this batch. So with this we have come to the end of this batch. So that's all personal decision. If you don't trade anything, your personal.
Because the reason I'm asking is because there are times that markets is not you're not just seeing anything.
So it always depends on the trader, because there are sometimes that yeah, you notice that sometimes like for me, that's it's not a general thing. For me, most times on Wednesdays and Fridays, my trade is not usually good. Sometimes it's good, but I've noticed it. I've no, it's not a general for me personally. I've noticed a thing. Wednesdays and Fridays is not usually a good time for me to trade. If I have a loss, 90% of the time is either on Wednesday or Friday. So most times, sometimes I'm careful about how I trade on Wednesday and Friday. If I want to trade at all on both days, I'm always careful of how I trade on both days. And sometimes I won't trade on those days. You understand? So it depends on your own. If you have, that's why you have to take stock record of your record of how you have been trading, of your growth, of how you are trading. So you have to know that what days are good for you to trade. You discover it yourself. You are taking check. You are going to discover. There are some people that Monday is a no for them. You understand? But I feel like Tuesday is a good time to trade because Monday markets will open. There will be a lot of rotation. But then Tuesday.
When they say 5% day, they're not be trading day. I mean,
So let me now ask you a question. If you trade today, can you make more than 5%? There are some days that you trade that you make 2 days profit in one day. So you are still. Mm. So what is the purpose of 5% daily? That means in a week you are making how many percent? 25%. So if you enter market today and you make 25%, are you supposed to trade for that week?
they still know you.
Let's see what. So you are not actually following your 5% daily. Yeah. So the purpose of 5%, so it's not like it's every day that you are trading, but it's just to give you a structure of what what stage I want to get to, how to track you can't just be entering market just making money. You have to have a structure. You understand? So that is what it's not like you have to be trading. There are some days that you do 10%. That means tomorrow you don't have to stress yourself. You understand? But if you can make money on that day, you are good. So that's why you have to always. So that's why this is a good way of this is a good way of taking track of your trade. Yes. So for example, let's say you are trading $100, 5% daily interest rate. Okay, let's say $50. So let's say we have 5, 10, 20 days in a month. Let's say for 3 months, that's 60 days. Daily invest rate 100%. Eh? Eh? For family problem. That one not concern us. Eh? And you can that's what daily invest rate. So that's it. If you want to put in everything, but this 100% means that you are still putting the whole everything in the market without withdrawing at all. If you want to be withdrawing, yeah. And I'm doing for 3 months. I'm doing simulation for 3 months. Yes, yes. Okay, let's do 1 month. Let's do 1 month. So 20 days in a month for $50, you are doing 5%. You are not trading Bitcoin on the weekend, and you are putting 100% in 1 month. Hmm? No. So in 1 month, your money will go to $132. So this is if you that's if you are following your structure. That means if you have $50 today and your target is 5%, this is what you are looking for in the market for that day. As soon as you get to 2.5, you are done for the day. You understand? You can it's equal. Yes, $2. Once you are done with $2, $2.5 for that day, you go house. You are done for that day. That's following your. So there are people that do 10% and above. That's why I'm saying that for small equities, is sometimes you can increase your your percentage profits to either 10 or 15. Yes, 10% is not bad for if you try. Yes, now $50. So if you have $50 now, is it not possible for you to make $5? Yeah. So it's easy for you to make $5 with $50. You understand? So, but so this yeah. So for 10%, but we don't want to stress. So 5%. You understand? So when your equity grows, this becomes like for example now somebody that is doing 1,000. 1,000. So in 1 month you've doubled it, $50. So when this all your so this thing makes you stay within your. It's possible to, with $50 you are making more than $5 in a day. But if you want to follow your trading plan, you are looking for $2.5 with $50. And don't be in a hurry. You understand? Because the same the same $50 that you grew to 132 in 1 month. So after your 20 days, you've grown your $50 to $132. That means after 20 days, your 132, after a month, you're already getting to 350 in the second month, in the third month. And I'm sure that more people you'll be getting more than sometimes, and there are sometimes that you will lose. So let's not put in the fact that you always win every day. But then this gives you a range of what you might have. So let's say after 1 month, your money was 300. instead of 350 that is, let's say let's factor in the loss, because if you are following your pattern you are not going to lose much. If you are actually following your daily target and all that, there are some days you get more than that and that's all, so your loss will not be more than, you understand, so let's do 300. Yeah, so I'll still simulate for that one. This for people that do not withdraw at all, you understand, so this is the third month, you're already in 795, you understand, after the third month concept. This is not aggressive trading, you are just slowly building, conservative. So now let's say for example now let's say you are somebody that you just daily food. Yes. Your account is account that there's daily food factored into it. That- so your $50 has to do a lot of activity. So for that, you know that you are not looking for 5%. You have to do more than 5%. You are looking for daily food. So let's say 10% in 1 month. Let's say you do 95, you remove your, yes, every day. Yes. So have you calculated? So yes. So you have your total cash without $13 for that month. You know reach. So your money was 270. So in 20 days, that will be just $13. That's like almost 20K. So let's say you want to, let's say $80. Let's say percent. 25. Yes. So you are still growing. That's the important thing. There's, yeah. Hey, there's another one. Let me. Oh no. So we use this one too. So let's see. Yeah? So the same. Let's see. Let's see.
I don't chop now. How I eat now.
Let's say
How I eat.
50. That's like $30. Oh. So let's say $20. Abi? So let's put this on as 100 then. So in 1 month,
1 month. Which one? Only for visitors.
I know. And you are withdrawing $20 every month.
They will take time to do that for 1 minute.
So
But this is the best way. Like move how much? Every week.
$80.
Every week. Or you time. Okay, no month. How much? A week. How much?
It's $20 a week.
How much is that? How much is that?
Eh?
How much is that?
$20 is like 30, almost 30. Even more than 30%.
I'll go with the place where I
What is
should go.
minus percentage?
Eh?
I visit them company now, and they go see me level.
How much I want there?
And you don't have
What's that? What I don't think I said.
Yeah, definitely. Yeah. So, so you see, like let's say the first day you make $5, your money was 55. Second day, 60. Third day, 66. That means on Friday you withdraw $20. So your money was $46. So the next week you start from there. 46 like that, yeah. You see that? It's a site. So you can save the site on your phone as a there's a way you can, like for example now you see you come here, you see where is that stuff? No, eh? No, on phone you can save it to desktop. On phone is not on phone. So it will now become like a no, like a folder on your phone. So you can click it. Anytime you click it, it just carry you. Eh? On your laptop, it will just stay there.
Yes, you are QR code. Save am for us. I will share am for. I will scan. I will try.
You can okay.
I don't praise you.
Okay.
I don't praise you. So I will share.
So that's that.
Okay. Thank you. And this comes to the end of this our batch.